We're now moving on to component accounting, also called componentization. In this section, we're also going to address basket purchases, also called lump sum purchases. This concept addresses the unit of measure issue. It addresses the issue of what exactly is an item of property, plant, and equipment. As an example, if you buy a machine, which items should be recognized? Just one item, machine? Or should we break down the machine into its significant parts, such as the motor, the frame, the safety gate? Or if you buy an office building, should it be recognized as one building in a building account? Or should it be broken down into multiple items, such as the foundation and frame, the roof, the windows, the air conditioning system, the elevators? And if we buy smaller items such as tools, should we group these together and recognize them as a single item under property, plant, and equipment? The degree of componentization is left up to professional judgment, but one thing is certain. Only separate out those parts whose values make up a significant portion of the whole asset's total costs. For example, if a building costs $800,000 and $100,000 of that is the value of the windows, a full 1/8 of the total value, then this could be considered significant, and therefore the windows would be a separate item under property, plant, and equipment. Consider also if the components have different useful lives. If the useful life of a frame for a machine is 20 years and the useful life of the motor is 8 years, then each of these components would be reported as separate items under property, plant, and equipment. In addition, the way the entity benefits from each component may differ, resulting in different methods of depreciation. For example, the building's benefit may be consistent, so straight line depreciation is used, while the roof may be providing more of a benefit in the first few years, so declining balance, also called diminishing balance, is more appropriate. If the benefits are received at different rates, this may indicate that components must be reported separately under property, plant, and equipment. These same indicators, the useful lives and the rate the benefits are received, can also be used to amalgamate smaller items, such as tools in a shop, together into one larger item under property, plant, and equipment. Remember that the issue of what constitutes a significant component requires professional judgment. Both IFRS and ASPE speak to the need to recognize components. Clearly, we can't buy an airplane and simply recognize it as one item under property, plant, and equipment. This then leads us to a related concept of a basket purchase. A basket purchase, also called a lump sum purchase, is where assets are purchased as a group at a price which is less than if each of the assets within the group were purchased separately. The price is lower to encourage the sale. For example, an empty factory with the land, building, equipment, and the remaining inventory are sold together. Keep in mind that due to component accounting, the single purchase price must be allocated to each of the items of property, plant, and equipment. When a basket purchase or lump sum purchase occurs, the most common method to allocate the purchase price between the various assets is called the proportionate method. This is where the purchase price is allocated to each of the individual items based on their relative fair value. Note that if any portion of the lump sum purchase can be directly attributed to a particular asset in the basket, then that item is assigned the full value first. The remainder of the purchase price will be allocated to the other items in the group. Let me give you an example. If the value of land in a grouping of land, building, equipment, and inventory is known with certainty, then that value would be deducted from the purchase price. The leftover purchase price would then be allocated to the remaining assets, the building, the equipment, and the inventory, using their fair values. Let's switch to Excel so I can provide an example. In our basket purchase example, we have a company that purchases a smaller company's factory for the total price of $650,000. The assets purchased have the following values. We can see the seller's carrying value. This is the accounting value that's placed on the seller's financial statements. For the land, $180,000. But we also have the asset's fair value, $450,000. We have the building with the carrying value of $120,000, but the asset's fair value is $260,000. We have the equipment carrying value $100,000. We have the fair value at $40,000 and the inventory carrying value $75,000, fair value $20,000. So the total value, carrying value, is $475,000. The total fair value is $770,000. A. Provide the calculation to allocate the $650,000 purchase price based on the relative fair value. So the first thing we need to do is do the allocation. The allocation is going to be based on the asset's fair values, and the sum of the allocation must be equal to the purchase price. So in this case, $650,000. To do the calculation, we're going to take each individual asset's fair value, divided by the total fair value, and multiply it by the purchase price. So in this case, for the land, we're going to take the $450,000 divided by the $770,000 and multiply it by the $650,000. As you can see, that number is not rounded, and since this is an estimate, we're definitely going to round this. Using the round function, I put in equal round bracket, then move over beyond the formula, comma, what I want it rounded to, 0 decimal places, and then closing bracket. You can see that the allocation is $379,870 for the land. We're going to do the exact same thing for the building. Divide the building's fair value of $260,000 by the $770,000 and multiply it by the $650,000, and we're going to use the round function again. The building is going to be allocated $219,481. Let's do the same thing for the equipment. Take the $40,000 fair value for the equipment, divide it by the $770,000 total fair value, multiply it by the purchase price of $650,000, which is equal to $33,766 rounded. Finally, let's do the inventory. Take the $20,000, divide it by $770,000, multiply it by $650,000, the purchase price, and that is equal to $16,883. To double check, let's just take the sum of all of the amounts that were allocated. $650,000. So the allocation is perfect. Let's get rid of that. So we answered A, provide a calculation to allocate the $650,000 purchase price based on the relative fair values. Let's go to B, discuss the impact of carrying amounts of the assets on your calculation. And the answer is they're irrelevant and they don't affect the calculation at all. Why not? That's because the carrying value is not representative of the fair value. Instead, we need to use the fair value of these assets in order to do the allocation. Note that once we have the allocation, we still may have to use component accounting. We have to break down each of these items into specific components. For instance, the building may have the basic structure, the roof, and the windows. That is the use of the proportionate method in order to allocate the purchase price over all of the assets that have been purchased in the basket. But we still have to ask ourselves, how do we determine fair value? What is fair value for purposes of the proportional method? Fair value may be a number of different things, such as the appraisal made by an insurance company or the value that was assessed by the city for property taxes. It might be an estimation of the replacement cost, or it could be an appraisal by, for instance, a professional appraiser or an engineer. Which fair value is most appropriate depends on the information available for each case. If land and a building are purchased, the relative property tax value of each is often used, but then an independent appraiser may be required to determine the relative values of each of the components which make up the building. So we're back at component accounting, the unit of measure which determines what an item of property, plant, and equipment really is. Remember that component accounting must be considered under both IFRS and ASPE standards, and we have to use the proportional method in order to allocate purchase price to the individual components.